Imagine this. You've just landed some incredible freelance work, maybe a booming side hustle, or you've decided to jump into consulting full time. The money hits your bank account, you're feeling great,
Yeah.
right? But then tax season rolls around, and instead of that familiar W-2 form, you get something entirely different, a form that practically shouts, "Surprise! We didn't withhold a dime for taxes."
Yeah, that moment of panic.
Exactly. If that gut punch feeling sounds all too real, or if you're even considering dipping your toes into the dynamic world of independent work, then get ready. Because today, we're not just talking about a form, we're giving you the ultimate blueprint for turning potential tax confusion into a powerful strategy for saving money and building financial resilience. We are diving deep into the 1099 NC. Today's deep dive is all about demystifying Form 1099 NEC, that's non-employee compensation. We're going to unpack exactly what it is, why it's fundamentally different from a W-2, and most importantly, what you need to do with it to ensure you're not leaving, potentially thousands of dollars on the table by missing valuable deductions.
Right.
Or even worse, inviting painful penalties from the IRS.
Right.
This isn't just about understanding some dry tax form. It's about empowering you with actionable knowledge. Knowledge to truly optimize your tax situation and gain critical control over your finances when you're working outside traditional employment.
And what's truly transformative here, I think, is recognizing that the 1099 NEC isn't just a notification of income. It's really your invitation to a whole new world of legitimate business deductions and strategic tax planning.
An invitation. I like that framing.
Because most independent contractors
Yeah.
honestly miss out on thousands. They just don't grasp that this form is less a bill and more, well, a blank slate for smart tax write-offs, provided you know how to leverage it.
Okay.
Understanding its implications, especially, how you correctly report the income and proactively plan for taxes, that is absolutely fundamental. Fundamental to avoiding costly mistakes and truly optimizing your tax situation. This form is your starting point for smart tax management when you're an independent contractor. It's the blueprint for how you interact with the tax system for this type of income, and mastering it can significantly impact your financial health.
And our primary guide for this deep dive is the Form 1099 NEC itself. Specifically, the official instructions designed for recipients like you. This document, it's packed with crucial information that often just gets overlooked. And we're here to highlight every important nugget, cut through the jargon, and give you the actionable insights you need to turn this piece of paper into a powerful financial tool. The basics. What is a 1099 NEC, and why does it matter to you? So let's start with the absolute fundamentals. What exactly is a 1099 NEC, and why should it matter so profoundly to anyone doing freelance work or in the gig economy?
Right.
At its core, Form 1099 NEC is the official IRS document used to report non-employee compensation. And the key term here, the one that defines everything that follows, is non-employee.
That's the critical word.
Yeah. When IRS says non-employee compensation, think independent contractor, freelancer, consultant, maybe a gig worker, essentially anyone providing services to a business or individual who isn't on their traditional payroll. And this immediately sets up the fundamental, really game-changing difference between a 1099 NEC and that familiar W-2 form you might have gotten in previous jobs. With a W-2, your employer, they're responsible for withholding various taxes from each paycheck, your federal income tax, your Social Security, your Medicare taxes. They handle that.
They take care of it up front.
Exactly. They handle that administrative burden for you, sending that money directly to the IRS throughout the year. But with a 1099 NEC, the payer, the business or individual paying you for your services, does not withhold these taxes.
None of it.
That responsibility falls squarely on your shoulders as the recipient. And this isn't just a minor administrative detail, it's a critical shift. A shift in who is accountable for those tax payments, and it directly impacts your financial planning, requiring a much more proactive approach from you.
And if we connect this to the bigger picture, the undeniable rise of the gig economy, independent work, well, understanding this distinction is more critical than ever before.
Absolutely.
The 1099 ADC reflects a fundamentally different relationship with the entity paying you. It signifies that you are, in the eyes of the IRS, essentially your own boss for this particular income stream. And that relationship carries significant new tax responsibilities for you as the recipient. This means you're now responsible not just for your income tax, but also for the employer and employee portions of Social Security and Medicare taxes.
Both halves.
Both halves, often collectively referred to as self-employment tax.
Yeah.
That effectively doubles your contribution to these programs compared to what an employee pays because there's no employer chipping in their half.
That's a big hit if you're not prepared.
It is. So this distinction, therefore, isn't just about a form. It's about recognizing your new role in the tax ecosystem and planning accordingly. It absolutely opens up opportunities for deductions. That's the upside.
Right, the tax saving part.
Exactly.
Okay.
But it also imposes crucial new obligations that, if you overlook them, can lead to serious financial headaches.
Okay, now that we understand what it is and why it's so important, let's peel back the layers of the physical form itself. Let's talk about the anatomy of Form 1099 NEC and its various copies. When you receive a 1099 NEC, you'll notice it typically comes with a few different copies, each serving a specific purpose, each destined for a different place. Like those old multi-part forms, you know?
Yeah. The carbon copies.
First, there's copy A. This one is distinctive because it almost always appears in red ink. Really stands out.
Right, the scannable one.
Exactly. This is the copy that goes directly to the IRS. It's designed to be scannable by their automated processing systems. And here's a crucial detail, a mistake people make that can lead to penalties. You cannot just print copy A from the IRS website, even if it looks identical, and file it.
No, that won't work.
If you do, a penalty might be imposed because those printouts are not genuinely scannable by the IRS's high-speed optical readers. The IRS is very clear about this. Official scannable copies must be ordered directly from the IRS or, purchased from an office supply store.
It's a requirement, not a suggestion.
Right. It carries real consequences for the payer, ensuring accurate and efficient data processing for millions of returns. Then you have copy B. This will likely be in black and white. This is for you, the recipient, the person who did the work.
Your copy.
This is your personal record, and it's the copy you'll use when you prepare and file your federal income tax return. Thankfully, you can download and print this copy directly from the IRS website for your own records in use. This is the one that's essential for your tax software or your tax preparer. Beyond that, for many of us, there are also state tax considerations, so you'll also receive copy 1, which is designated for your state tax department.
If your state has income tax, yeah.
Right. Many states have their own income tax requirements, and this copy ensures they get the necessary info about your non-employee compensation. And finally, copy 2 is also for your state, specifically to be filed with your recipient's state income tax return when required by your state's particular tax laws.
So it covers federal, state, and your own records.
Pretty much. All bases covered.
Mhm.
And just to briefly touch on the payer side for context, the businesses or individuals who issue these 1099 NECs, they also have very specific rules they must follow. For example, if they're filing 10 or more of these information returns, they're generally required to e-file them. Even if they have fewer, the IRS strongly encourages e-filing. It's more efficient, fewer errors.
Makes sense.
And if they choose to file on paper, they must order those official scannable copy A forms directly from the IRS. As we mentioned, the penalty for filing non-scannable forms applies to them too, reinforcing how important this seemingly minor detail is for the IRS's massive data collection efforts.
You know, this deep dive into the purpose of each copy and the emphasis on scannability, it really highlights the sophistication of the IRS's system. It underscores the multifaceted nature of tax compliance.
Yeah, it's complex.
You've got federal obligations, state obligations, and your own personal record keeping. The strict requirement for scannable forms for copy A, well, it showcases the IRS's need for efficient processing of millions of tax documents annually, ensuring they can cross-reference data. For you as the recipient, understanding the system helps you appreciate that the IRS already has a record of your income before you even file your return.
That's a key point. They already know.
They already know, which makes accurate reporting on your end even more crucial. It's about matching what the IRS sees with what you report.
Yeah.
That's a cornerstone of effective tax management and, frankly, avoiding audit triggers. It removes any illusion that this income can just, fly under the radar.
All right, let's get into the specifics of what's actually on your 1099 NEC form. It might look like a jumble of boxes and numbers, but each one tells a part of your tax story, and knowing what each means is your first step towards mastery and ultimately saving on taxes. First, at the top, you'll see the payer's name, address, TIN, taxpayer identification number, and usually a phone number. That's the info for the person or entity who paid you.
Right.
Right next to that, you'll see your own recipient's name, street address, and TIN. Your taxpayer identification number, or TIN, that's basically your tax ID card. For individuals, usually your social security number, SSN.
Or an ITIN for non-residents sometime.
Exactly. Or an ITIN if you're a non-resident alien with tax obligations but can't get an SSN. There's also an ATN for certain adoption situations, and if you've set up a business entity like an LLC or corporation, you'll have an employer identification number, an EIN.
Hmm?
Now, for your protection, your TIN on copy B might only show the last 4 digits. That's a common security measure.
Standard practice.
But rest assured, the full TIN is reported to the IRS by the payer. Below your address, you might see an account number. This is optional, something the payer might use internally. Not usually critical for your taxes, but it could help you match payments if you get multiple from the same source. Now, let's unpack the boxes, because this is where the financial strategy, the tax-saving part, truly begins. Box 1. Non-employee compensation. This is your primary focus. The star of the show, really.
A main event.
This box shows the total amount of money paid to you for services where no income, Social Security, or Medicare taxes were withheld. This is the number that will immediately get the IRS's attention if it's not reported correctly on your return. It represents your gross income from your independent work. And it's the jumping-off point for determining your tax liability and, critically, what powerful deductions you might be able to take to reduce that liability. This is where your diligent record-keeping starts to really pay off. Okay, box 2. Payer made direct sales totaling $5,000 or more of consumer products to recipient for resale. If this box is checked, it means the payer sold you $5,000 or more of consumer products for resale. Think multi-level marketing. Direct sales.
Where you buy inventory first.
Right, where you purchase products and then sell them to consumers. This generally means you'll need to report any income you earn from selling these products, and typically it will be reported on Schedule C, which again is where you can also account for your cost of goods sold and other business expenses, helping you optimize your net income. Tax savings opportunity right there. Box 3. Excess golden parachute payments. Now, here's a box that's far less common for the average gig worker or freelancer, but it's important to know it exists.
Very uncommon for most.
Yeah. This box shows total compensation from excess golden parachute payments. These are specific, often very high-value payments, usually to executives when a company changes control, and they're subject to a hefty 20% excise tax on top of regular income tax.
Ouch.
If you see an amount here, you'll definitely want to consult your tax return instructions and probably a tax pro. It's a highly specialized area. Safe to say, for most of us, this box will be empty. Box 4. Federal income tax withheld. Okay, this box is a bit different. While the general rule for 1099 NEC is no withholding, this box indicates money that the payer actually did withhold from your payments.
Usually backup withholding.
Exactly. This typically happens under what's called backup withholding. Maybe you forgot to fill out the W-9 form correctly, or you gave the wrong TIN.
Or had prior underreporting issues.
Right. Suddenly your payment is short. That's often backup withholding. The payer is legally required to hold back funds in those cases. But the good news here is that any amount shown in box 4 is money you've already paid towards your federal tax bill.
You get credit for it.
You get full credit for this amount on your tax return. So don't overlook it. It's a payment you've already made. Crucial for calculating what you owe or what refund you might get. And finally, boxes 5 through 7 are specifically for state information. Box 5 shows any state income tax that was withheld. Box 6 gives the state ID number for where the income was earned or the payer's state number. And Box 7 shows the amount of state income.
Essential for your state return.
Absolutely. These boxes are crucial for reporting your income accurately on your state tax returns if your state has an income tax. Ensures you meet your state-level obligations just like your federal ones.
Understanding each box is it's absolutely crucial for completing your tax return accurately.
Yeah.
Box 1 is your main event, no doubt, representing the core of your non-employee compensation. But the presence of Box 4, for instance, highlights that common pitfall, a breakdown in providing accurate ID, leading to backup withholding. While it's a consequence, you do get credit for it, so it's vital to recognize that. Knowing what each box represents is really the first step in avoiding those kinds of surprises and accurately reporting your income. And that's foundational to smart tax management. It's about recognizing every piece of the puzzle so you can assemble your complete tax picture without missing anything or making errors. This proactive approach ensures you're not paying more than you owe and that you're in full compliance. 2. Decoding your income. Where does it go? The heart of tax management for recipients.
Okay, now we move to the absolute heart of tax management for anyone getting a 1099 NEC, decoding your income and making sure it goes to the right place on your tax forms. This is where your understanding of the form directly translates into effective tax planning and, importantly, maximizing your potential tax savings. The first big question this form forces you to ask, and it's a really critical one, is, am I really an independent contractor, or should I have been classified as an employee?
The classification question.
Yeah.
Always important.
Yeah. Sometimes a business might issue a 1099 NEC, but based on the specifics of your working relationship, how much control they had, were you integrated into their business, did they provide tools, set hours, all that stuff?
The control factors.
Right. You might genuinely believe you should have been treated as an employee. This is a common point of contention. So, if you receive a 1099 NEC, but you genuinely believe you should have been classified as an employee, the IRS instructions are very clear about what to do. You should report the amount from Box 1 on the line for wages, salaries, tips, etc. of your Form 1040, 1040-SR, or 1040-NR.
Okay.
And crucially, you must also complete Form 89919. That's uncollected Social Security and Medicare tax on wages, and you attach it to your return. This form helps you calculate the employee's share of those taxes that weren't withheld. For more detailed info on this, because it can get complex, the IRS strongly recommends checking out Publication 1779, Independent Contractor or Employee. It outlines the criteria the IRS uses, which is invaluable if you're in this boat.
And this raises the important question. Why does this classification matter so much? Why fight it?
Right.
Well, the distinction impacts everything. It affects who pays Social Security and Medicare taxes. Remember, as a contractor, you pay both halves.
The self-employment tax.
Exactly. It impacts eligibility for unemployment, workers' comp, even employee benefits like health insurance or retirement plans. And, crucially for your tax management and savings, it dictates what expenses you can deduct. As an employee, your deductions are much more limited compared to a self-employed individual. Misclassification can have serious consequences for both the business and for you. For you, it dictates the whole structure of your tax return, how much self-employment tax you owe, and whether you can tap into those significant business deductions.
So getting it right is key for tax strategy.
Absolutely. Correct classification is a major pillar of smart tax strategy and avoiding potential audits. It dictates whether you're building a business or just, filling a role.
Okay, now, if you are truly not an employee and you agree with the independent contractor classification, this is where your income takes one of two distinct paths for reporting. And choosing the right path is paramount for effective tax management and maximizing any potential tax savings. This is the fork in the road. Path 1, sporadic activity or hobby income. This path applies if the amount in Box 1 is not considered self-employment income because you don't do it with the primary intent to make a profit.
The hobby loss rules come into play here.
Exactly. Think of it as income from a sporadic activity or a hobby. Maybe you occasionally sell a few crafts online, or you get paid for a one-off project that isn't part of an ongoing business you intend to grow. If that's your situation, you report the Box 1 amount on the other income line on Schedule 1, Form 1040. This is for situations where you're not operating a true trade or business. Now, here's the critical implication for tax management if you classify it this way. Generally, expenses related to a hobby are limited or, in many cases, not deductible against this income anymore.
That's a big change from past years.
It is. This makes hobby income significantly less tax efficient if you actually incurred business-like expenses. You'd be reporting the gross income without being able to offset it with the costs. So, if you sell paintings as a hobby, get a 1099 NEC, you generally can't deduct the cost of paints, canvases, classes, limits your ability to reduce taxable income. This is why accurately assessing your intent to profit is so crucial. Path 2, self-employment, SE income. This is the path for the vast majority of independent contractors, freelancers, gig workers, anyone operating with a clear intent to make a profit.
Even if it's a side hustle?
Yes, even if it's a side hustle. If the amount in Box 1 is self-employment income, meaning you're running a trade or business aiming for profit, then your reporting differs substantially. And this is where true tax optimization, the real tax saving strategy, begins. This is where you unlock the power of deductions. If you operate as a sole proprietor, basically, you're an individual working for yourself, no separate legal entity. You report this income on Schedule C, profit or loss from business, or possibly Schedule F for farming, both attached to your Form 1040.
Schedule C is the key form for most.
Right. Schedule C is where you list all your gross income from the business, and then, this is crucial, you deduct all your legitimate business expenses. That gets you to your net profit or loss. And that net profit is what you pay income tax and self-employment tax on. Now, if you're part of a partnership, the income would first hit Form 1065, the partnership return. Then you, as the partner, get a Schedule K-1 showing your share.
Your share of income and deductions.
You'd use that K-1 info to complete Schedule SC, Form 1040, to calculate your self-employment tax, making sure you contribute to Social Security and Medicare.
So what does this all mean for tax savings and smart tax management? Why is Pass 2 usually better if it fits?
Kill us.
Reporting income on Schedule C or F is where the door swings wide open for deducting legitimate business expenses. This is the critical distinction. It's the primary way to significantly reduce your taxable income when you're self-employed.
This is the core tax-saving mechanism.
Exactly. If you treat income from an ongoing business as just other income from a hobby, you are likely missing out on significant deductions. Things like your home office expenses. And yes, there's a specific simplified deduction for that now. Makes it easier.
Okay.
Your internet bill, a portion of your cell phone, software subscriptions like Adobe Creative Cloud or Canva Pro, professional development courses, business mileage, which adds up fast, certain business meals under specific rules, and even health insurance premiums for the self-employed. That last one can be deducted above the line, reducing your adjusted gross income directly. Huge potential savings there. These deductions can substantially reduce your net self-employment income, and that, in turn, reduces both your income tax liability and your self-employment tax burden. Think about it. If you're a rideshare driver, your mileage, car maintenance, even part of your phone bill are potentially deductible.
Right.
If you're a graphic designer working from home, your dedicated office space, design software, professional association, dues all potential write-offs. This is foundational to truly managing your tax burden when you're self-employed. It transforms that gross income figure in box 1 into a much lower net taxable income. It's not about avoiding taxes, it's about paying taxes only on your actual profit. This is your core strategy for true tax optimization as an independent contractor.
Okay, let's quickly circle back and cover the reporting for the other boxes just to make sure we've nailed down where every figure on your 1099 NEC should land on your tax forms. For box 2, direct sales, as we mentioned, if it's checked, you bought $5,000 plus of products for resale. Generally, income from selling those products goes on Schedule C.
Form 1040.
Back to Schedule C again. Exactly. Another pathway pointing directly back to potential business deductions. You'd account for the cost of the products you bought, your marketing, shipping, any other selling costs. You report the net profit, not just the gross sales. Another chance to use those business expenses to lower your tax bill. Regarding box 3, excess golden parachute payments again, rare for most listeners. If you do have an amount here, you need to check your tax return instructions carefully. It's subject to that distinct 20% excise tax plus regular income tax.
Definitely a get professional help situation.
Almost certainly. Highly specialized area, significant tax implications. And finally, for box 4, federal income tax withheld. This is straightforward, but so important not to miss. The amount in this box gets included on your income tax return as tax already paid.
Like a down payment on your taxes.
Precisely. It's money you've already sent to the IRS, just like W-2 withholding. So make absolutely certain it's counted when you calculate your total payments and figure out if you owe more or are getting a refund. Don't leave that money on the table. It's a direct reduction of your final tax liability. 3. Proactive tax management. Estimated payments and avoiding pitfalls. Okay, now let's talk about maybe the single most crucial aspect of proactive tax management for anyone receiving a 1099 NEC, and that's estimated tax payments and how to avoid those unwelcome, often costly pitfalls.
This is where discipline really pays off.
It really does. This is where being an independent contractor demands a new level of financial planning. Here's where being proactive truly saves you money and hassle come tax season. The instructions for Form 1099 NEC state it plainly. If you are receiving payments on which no income, Social Security, and Medicare taxes are withheld, you should make estimated tax payments.
It's not optional, really.
It's not just a suggestion. It's fundamental to how our pay-as-you-go tax system works for the self-employed. So why is this mandate so important? Unlike traditional employment, where your employer handles withholding automatically, independent contractors are responsible for paying their own income and self-employment taxes as they earn the income.
Throughout the year.
Throughout the year. If no one's withholding for you, then you have to make those payments yourself, typically in 4 quarterly installments. The deadlines are usually April 15th, June 15th, September 15th, and then January 15th of the next year. Miss these deadlines or pay too little relative to your income, and you could face underpayment penalties.
And those penalties add up.
To help you figure this out, The IRS provides tools like Form 1040-ES, estimated tax for individuals, or Form 1040-ES-NR for non-resident
With
aliens.
worksheets to help calculate.
Exactly. They include worksheets to help you estimate your income and deductions for the year and figure out your estimated tax payments. A common strategy people use is the safe harbor rule.
Ah, yes, the safe harbors.
Right. If you pay at least 90% of your current year's tax liability through withholding and estimated payments, or 100% of your prior year's tax liability, that threshold goes up to 110% if your adjusted gross income was over $150,000. You can generally avoid those underpayment penalties.
Basing it on the prior year is often simpler for planning.
Many independent contractors find it easier, yeah. Basing payments on the previous year's tax simplifies calculations and helps ensure they meet that safe harbor. It's also important to note that this estimated payment requirement isn't just for individuals like freelancers. It also applies to corporations, fiduciaries like trusts and estates generating income and partnerships.
Anyone earning income without withholding, basically.
Pretty much, anyone receiving income without tax withholding generally needs to consider making estimated payments to avoid penalties. If you're managing a trust that earns income, for example, you might have these responsibilities too.
And this really is a cornerstone of effective tax management for anyone with non-employee compensation. Failing to make sufficient estimated payments throughout the year will likely lead to underpayment penalties from the IRS.
Money down the drain.
Exactly.
Yeah.
It's not just about eventually paying the tax. It's about paying it on time and as you earn it throughout the year. Think of it like managing your business cash flow. By consistently making estimated payments, you're preventing that huge, potentially painful tax bill, plus an additional penalty from hitting you all at once at year-end or on April 15th. This is a clear, direct strategy for tax saving simply by avoiding those penalties.
Which can be significant.
They can be significant and just eat into your hard-earned profits. It also helps hugely with financial planning. You're setting aside funds for taxes as the income comes in, rather than facing a large, unexpected liability later.
Yeah.
It's proactive budgeting, not reactive scrambling. Honestly, I often tell clients that the mental peace of mind alone, just knowing your tax burden is being managed throughout the year, is worth the effort of making those estimated payments.
Beyond estimated payments, there's a small but significant detail related to security and verification that the form instructions highlight. It reinforces the IRS's awareness of your income. When you look at your Copy B, you'll notice that for your protection, your taxpayer identification number, TIN, your SSN, ITIN, EIN, whatever it is, might only show the last 4 digits.
That's standard practice for privacy.
Right. It's a common and important security measure to protect your sensitive personal information from just floating around. However, it's crucial to understand, even though you only see the truncated number on your copy, the issuer of the 1099 NEC has reported your complete TIN to the IRS on Copy A.
The IRS has the full number.
Exactly. This means the IRS has the full information and is actively matching the income reported by the payer to your tax records. It underscores the importance, again, of accurately reporting all income shown on your 1099 NEC. The IRS already has a copy of what the payer reported.
No hiding it.
This cross-referencing is a key mechanism for tax compliance. So accurate reporting on your end isn't just good practice, it's essential for avoiding discrepancies that could flag your return for review.
You know, that small detail really speaks to the intricate balance the IRS tries to strike between transparency for their tracking purposes and privacy for the taxpayer.
It's a fine line.
It is, and it's a constant reminder that while the form itself might seem simple, it's part of a much larger interconnected system. A system designed to track income, ensure compliance, and minimize fraud across millions and millions of taxpayers. For you, it reinforces the message. The IRS knows about this income from the moment the payer files their Copy A, so you absolutely need to report it. It also highlights the importance of keeping your TIN secure, only providing it to legitimate payers when necessary. Protect your identity while meeting your tax obligations. It means no income goes unnoticed. IV, beyond the form, resources and future steps.
Okay, this deep dive has certainly shone a light on the intricacies of the 1099 NEC and its profound implications for independent contractors. But the learning doesn't have to stop here. The IRS actually provides a wealth of resources that can help you navigate your tax obligations even further and truly master your financial management as a self-employed individual. They publish various guides and publications that delve into specific topics in much more detail than we can cover in a single deep dive. For instance, if you're interested in the nitty-gritty of printing official tax forms for payers, you can check out publications 1141, 1167, and 1179.
More for the payers, but good to know.
Right. And if that initial critical question we discussed, whether you should really be classified as an independent contractor or an employee, if that still lingers for you, maybe you're unsure if your working relationship truly qualifies as self-employment. Publication 1779, Independent Contractor or Employee, is an invaluable resource.
That's a really important one.
It really is. It lays out the precise criteria the IRS uses to make that determination, helping you understand your status and avoid potential misclassification issues. Beyond publications, the IRS maintains several online resources that are constantly updated, with the latest information and any future developments regarding tax laws, tax law changes.
Constantly.
You can find up-to-the-minute information related to Form 1099 NEC and other information returns at www.irs.gov Form 1099, www.irs.gov and www.irs.gov employer forms. For future developments specific to the 1099 NEC, they even have a dedicated page, www.irs.gov Form 1099 NEC. These are excellent bookmarks for staying current on tax laws that might affect your independent income. Helps ensure you're always operating with the most accurate information. And one more fantastic resource that many people unfortunately overlook, the IRS Free File program.
Oh, yeah. Free file's great.
It really is. If you meet certain income requirements, and they're pretty generous for many individuals and families, you can go to www.irs.gov free file. See if you qualify for no-cost online federal tax preparation, e-filing, and even direct deposit or payment options.
Can save you significant prep fees.
Absolutely. It can be a huge time and money saver for eligible taxpayers, helping you prepare your Schedule C, calculate your self-employment taxes, all without incurring additional software or preparation fees. It's a powerful tool that puts professional-grade tax filing within reach for free.
This whole deep dive into the 1099 NEC really highlights something fundamental. When it comes to taxes, knowledge isn't just power, it's profound financial peace of mind.
Well said.
The information is out there. It's readily available, often free, directly from the IRS. Being proactive in understanding these foundational documents, like the instructions for your 1099 NEC, is absolutely key. Key to effective tax management and maximizing your legitimate tax advantages. Don't wait until April 15th to figure out what your 1099 NEC means or to scramble to find your expenses. Start exploring it as soon as you receive it. And integrate expense tracking into your routine throughout the year. Use an app, a spreadsheet, whatever works.
Make it a habit.
Make it a habit. The earlier you understand your obligations and opportunities, the better positioned you are to optimize your tax situation and keep more of your hard-earned money. And this raises an important question for all independent contractors listening. How can you leverage these resources and this newfound knowledge to stay ahead of the curve? Instead of just reacting to deadlines and potentially missing out on valuable deductions or, worse, incurring penalties. It's really about building a consistent habit, a habit of reviewing your financial documents, understanding their implications as they come in, and continuously educating yourself. It's the difference between feeling overwhelmed by taxes and feeling empowered by your financial choices. Outro.
So what does this all mean for you, the independent worker, the freelancer, the gig economy participant, navigating the complexities of non-employee compensation?
Well, the 1099 NEC, it's more than just a piece of paper. It's a signal.
A flag.
A flag, exactly. It tells you that you're operating differently in the tax world, specifically as an independent contractor. And with that comes specific but definitely manageable responsibilities. We've learned that getting your income correctly classified, distinguishing between that sporadic hobby and a legitimate self-employment business is absolutely crucial. Crucial for unlocking powerful deductions that can significantly reduce your taxable income. That's a direct tax saving. Key for optimization.
And we've also seen that diligently making estimated tax payments throughout the year is your secret weapon against year-end surprises and those nasty underpayment penalties from the IRS. These steps, they aren't just about compliance, they are direct paths to smarter tax management, greater financial control, and ultimately putting more money back in your pocket.
In this deep dive into the 1099 NEC, it reveals a fundamental truth about independent work, doesn't it? Your autonomy, your freedom, it comes bundled with increased personal responsibility for tax management.
No escaping that.
No escaping it. But the real tax saving often comes not from finding some obscure loophole, but from meticulously understanding and consistently applying the basic rules, like the ones found right there in the instructions for a 1099 NEC. It's about ensuring your income is reported correctly, that you claim every single legitimate deduction available to you, don't leave money on the table, and that you fulfill your payment obligations on time. What stands out to you listening right now should be the empowerment that comes from truly mastering these foundational tax concepts. It transforms what might seem like a burden into a clear path towards financial resilience, and maybe, just maybe, even greater prosperity. The control is yours to take.
Keep learning, keep asking questions, and keep diving deep into the knowledge that empowers you to take control of your financial future. Until next time, stay well-informed and strategically tax-savvy.